Hello, everybody. Again, this is the Option Professor of OptionProfessor.com. A quick background on ourselves here. Graduate of Boston College and been in the investment arena for decades. So we have a certain amount of product knowledge on investing, and we have done seminars throughout the country and actually internationally going back decades as well. And so basically we have educated and instructed many investors on the uses and the risks of investing. So we're trying to get our knowledge and experience and share it with people. And we do have a weekly newsletter that we put out that we'll talk about at the end of the broadcast. But right now we are going to be talking about three things. One is trading psychology. The second is going to be time management. And the third is discipline while you're trading. Okay, so these are 3 points we're going to cover, and looking forward to filling in some gaps on that. Again, we're sharing our opinions and our observations. Basically, many people have different ones. This is ours. With regards to trading psychology and time management, I think they kind of go together. Your trading psychology, should be have some foundation. Right. And so what sometimes we go towards is different themes and different sectors that seem to fit into the themes that we have. So basically, last year, we saw a collapse in the stock market in 2020, and we saw a nice 38% drop in the S&P, which is kind of a Fibonacci number. And so basically, we thought that area made sense for it to stop. When you brought the Federal Reserve in with both guns blazing, you obviously had somebody backing up the liquidity part of the market, and you got a little bit of a signal that it's probably okay to start getting into something. The theme is everyone's going to be staying at home, so things that have to do with technology would obviously be the logical reason why people would be investing in those type of companies. And there you went with your Zoom and your Teledoc and your DocuSign and your other types of companies that benefited from stay at home. And of course, the tech firms, home delivery at low prices, right? That was the big thing. If you had a takeout restaurant, you made out like a bandit. If you had sit down like the Cheesecake Factory and other people, you didn't do so well. So the first stage of the recovery were the companies that took advantage of people are stuck at home, but they still got to eat. They still want to get stuff, and they need to communicate even though they're not going to the office, and they need to get exercise even though they can't go to the gym. So obviously the first stocks to go would be those. And then that's the psychology of what the theme is going to be. And then you look for stocks in that type of sector. And, just to throw up a few on the screen here so you get an idea, you look at Zoom and you go back a year. Well, actually, yeah, I guess it's about a year now. And you'll see some examples of what I'm talking about. So you can see Zoom. This is 6 months. I got to give it a year so you can see it. And you'll see, obviously, during this is going back, call it April, May right here, right? Same idea. You get a huge run up during the what? During the shutdown, right? So that's an example of why that made so much sense. And then you go to something like Peloton, and you get a similar chart. And the Peloton, again, here comes the shutdown. You got to go to, you can't gain 500 pounds at home eating bonbons. You're going to have to get exercise. So there you go. Now, again, you notice both charts have rolled over to the downside because the reopening is happening and people can go to the gym, and maybe they don't want to just sit in their living room riding a bike, listening to some lady yell at them, keep going, right? So the bottom line is the habits are changing a bit. And so that gives you an example of what we were looking at a year ago. Then 6 months ago or so, maybe 9 months, we were saying to ourselves, okay, we got the tech gone nuts on the upside. You had, Apple go crazy on the upside. You had all the, tech companies going nuts. Semiconductors went nuts. But what's going to happen next? Well, interest rates are not going to stay low with this type of a boom coming back in and with this kind of Fed support. You're not going to see, the prices rise and activity go up and earnings go crazy without some type of a pop in the bond market. See the bond market here going back a year. This is a collapse in the bond market during the pandemic when interest rates are dropping, right? Excuse me, I'm sorry. Interest rates are rising during this environment. Okay. Why is that? Again, because you saw that there was still a lot of money being spent. Households have a lot of money, and you're looking at zero interest rates. This is during the panic, right? During the panic. Okay, everyone's running into the bond market, and this is them saying, this is a 20-year instrument. Over the next 20 years, with this kind of stimulus, with this kind of money printing, with this kind of expansion into household savings, millennials are going to inherit like trillions of dollars. The graying of the silver tsunami, more people are going to become 60 and more, and they're going to want to get out of the house and spend all this money that they haven't spent. Imagine never spending any money on dining to speak of or travel. Do you know how much money that is? Well, it gives you an idea because look how much money is in savings accounts now, and look how much deleveraging occurred with people paying down their debt. Of course. So now these things are opening up, and obviously they're going to be spending on that kind of stuff. So interest rates were down here at zero, and then obviously people can see the inflation is going to pick up, the GDP is going to pick up, the employments are going to collapse down to normal levels, and in that environment, interest rates don't go down, they actually go up. And this is yields going up, which they've done. Okay, so there you go. You've had a nice big move up in the interest rate market. When you get that happening, what people are helped by that? And the people that are helped by that are value, banks, energy, metals, and international. And that's where our focus has been for the last 6 or 9 months. And it continues to be in that area because we think there's plenty of runway in those areas. So basically, we'll give you some ideas in the last 6 or 9 months where we have been thinking. So your psychology has to be about a couple of things in our view. What sectors make the most sense? And then your asset allocation. The more you have in bonds and the less you have in stock. Theoretically and historically, less volatile has been your principle. Okay. Whether that's going to continue or not is anyone's debate. But historically, you can't debate that an 80% bonds and 20% stock portfolio has been less volatile over time than an all stock portfolio. I don't think that's debatable. So your asset allocation is important, and your sector choices are very important. So let's take a look at some of the sectors that we're looking at, and then basically you can take a look at them. I'm using these for illustrative purposes only. There's 9 million ETFs out there. I'm just going to be able to talk one at a time, right? So basically you're looking at, let's see, MGV, which is your mega cap value. Now, these are going to be big companies. Their PEs are not going to be as high as the tech, obviously. And so this is one that, again, in the last 6 or 9 months, you can see if we go back to 6 months or 9 months, you're back in the September, November timeframe. And this is where we were very much encouraging people. This was the place to be. And as you can see, it has been the place to be. And although we may see pullbacks, et cetera, you can see your RSI has been above 50 the entire time, pretty much. A couple of little dips. Well, you can live with that. When your moving average is rising and you get a dip, don't get afraid. Just get this and make sure it gets back above there quickly, like it does, and then stay with the game. With regards to, so here's a good example of value. The other things that are benefiting in this environment would be your banks, because you have a steepening of the yield curve. Banks don't pay you any money for your deposit, and now the loans they're making are at a higher rate. And if you want to take a line of credit, it's at a higher rate than zero, right? So their profits can expand. Now, let's take a look at an example on a couple of these things here. One would be a broad-based, these are big banks, larger banks. And these are, your JP Morgans, your Citigroups, your Bank of Americas, your Wells Fargos, you know who they are. Okay, again, same story. And this is where we changed our tune 6 or 9 months ago. And we started to see the things going up. So you get on the train and you ride it. Looks very similar to value, doesn't it? Almost looks like the same chart. Okay. And again, it still looks like it's going. Could it pull back? Of course it could. But as long as I see this blue line like a hockey player, as long as it's above the blue line, you're good. You get under the blue line, they could put you in the penalty box for a little while, but you don't want to be in the penalty box very long. You want this thing, if it does penetrate, to get back above it quick. And so it only had one penetration of it, and it got right above it very quickly. So that's good. All right. So there you go. And then where's your RSI? Your RSI is above 50. So those are the reasons you get into that kind of stuff. Another one would be the energy sector. Well, let me give you another one for these are regional banks. And there's a couple of regional bank ones here that are interesting. And there you go. So again, the psychology is I want to be involved in the right sectors, and I want to have my asset allocation model so it's not too heavily in equities in case equities get volatile. The more you have in bonds versus stock, it's supposed to make your portfolio historically and theoretically less volatile. So there you go with the banking, the regionals. Same idea. September, October, November. The interest rates are rising. Time to go into things that benefit from rising rates and inflation, right? And there's another example of it again. Okay. Another one is KBE. And here you go. KBE. Again, same story. Pretty much it's a regional type deal again. And same story. Okay. So you got your value, you got your banks. Now what else you got going? How about some energy? You think we're going to use less energy if everybody comes out of their house or more? You think we're going to use less energy or more if people start flying all over the place? I don't know. You make your own decision. Our feeling is it's going to be more. So same idea. We're in the November timeframe, right? October. We get the signal down here, and it's ride the train up all the way. One time it penetrated, then it penetrated here. Now it looks like it's getting back on the bicycle. RSI really has not been able to stay under 50 for any length of time. That's positive. And now it looks like it wants to go. So again, doesn't have to go up, doesn't have to, do what we want it to do, but we do think there's an opportunity with energy, and it does. And then this thing pays pretty good dividends and distributions. So nothing wrong with that either. In the energy sector, you also have exploration. And these guys are in the exploration business and production business. They distribute their cash as well. And as you can see, similar to the other, the big buy was back when we were talking about it 9 months ago. And now, of course, it had a pullback, and the RSI is back above 50, I believe, at 56, and the prices are above 80. So, as long as you stay above 75, 80, you're not doing too bad there. So keep an eye on that one. And then the other one is services on energy. And on services on energy, here you go. So there you go. It's trying to get going as well, not as robust. Let's see how it does in the next few days. Just to give you an idea what kind of potential could be in this thing if things really started to go. Obviously, you can see this thing has had quite a bit of a volatile period of time to the downside, but over the last 20 years, this number down here is about as low as it's ever been. So still an overall downtrend. And this is out of the three, our opinion is the most risky, but it also can be the most rewarding if it gets going. So you keep an eye on it and see what happens. So we looked at the energy market. We looked at the banking market. We looked at the value area. Now, let's see, another area is international. Reason we're looking at international is we're trying to use our common sense. Sometimes it bites you in the butt. Sometimes it's good. 6 or 9 months ago, we had no vaccine. and unemployment had 10 million people out of work. But a lot of it was in the service sector, right? And why wouldn't they be? The restaurants were closed. You can't go to a convention at the Javits Center, and you can't go to a convention in Vegas. You don't need a lot of travel agents, right? And all the people who take all those tickets in, they don't need them. So obviously, our economy and our environment was very much shut down 6-9 months ago, right? But then came the vaccines, then come the openings, then come the plane rides, then the casinos open, then the restaurants are packed, and that's where we are now, right? So what about in Europe? Are they, we're at 40%, we're getting to be 40% vaccinated, which really is the key to the next level in the stock market, in our view, because of if the vaccinations jump to 40, 60%, and the expansion of the blowout comes out faster, then, we got maybe another leg to run. But in Europe, they are behind us as far as vaccinations are concerned. So they're still in shutdown. So what do you think, if you were looking out 6 or 9 months in Europe, that the banks and the businesses would be doing after they open and stimulus hits there, et cetera? Well, our guess would be that they'll be doing better. And so we're looking at valuations over in Europe, which are much different than they are here. And we're also looking at banks over in Europe, where their price to book comes in much lower than ours. So we think there could be value there. So that's why we're taking a look. If you look at a banking ETF over there, EUFN, let's take a look at what it looks like and see if there could be something going on. Because again, it is important to look where the puck is going, right? You can't, like what did Lee Iacocca, the old legendary guy from Chrysler, say? If you stand still in the auto business, you get run over. That's probably true in the investment business sometimes too. So anyway, here you go with European financials. Okay. And you can see that it has an RSI now above 50, right? We like that. And we do like the fact that it's above all its moving averages. We want it to hold up here so all these averages can cross. And then hopefully we'll be able to get some further activity on the upside. And that's a 20-year graph. Let's look at a 1 year. And the 1 year, this thing has been going up, probably the same time. Look, same time as the other value stuff, right? Remember, we said this was the turning point in value. This was the turning point in banks. This was the turning point in energy. And it was the turning point in financials of Europe as well. And again, we are of the opinion that there's a potential for it to continue. And that's why we have a focus. So your psychology again is, I want to have an asset allocation that I can sleep with based on volatility. So that would be a mixture of stocks and bonds. And secondly, I want to be in the sectors that seem to be going to benefit from reopenings, inflation, and a steepening yield curve. Okay. Now, don't forget, these guys have negative interest rates, but if you go borrow money over there, they're not going to let you borrow for free. So they must have some spread. At any rate, there's what you're looking at. You're looking at something that has a nice trend to it, and the RSI is above 50. So we like the financials over in Europe. With regards to each area, let's take a look at Europe. Now, this would be broad-based Europe, so it'd be many companies, many industries represented. Okay. Again, where did you get your buy signal? Same time you got it on the what? On the banks and all the energy and the European financials, right? Boom. And value. And so it is an ongoing trend, we think. And you can see the RSI is above 50. So obviously we think it's a stay with it type of deal. And we think that Europe and the banks should do better once they reopen, once they get out there spending their money, and once they start getting people over in Europe. Nobody can travel there, but they're going to open that up in the summer. And I, for one, would like to go to Paris and go down to the south towards Marseille and then to Monte Carlo, play some golf, have some fun, get the heck out of the house, right? I'm sure I'm not in a party of one. So there you go. And that's what we're thinking is going to happen. And I hope while I'm doing this summer, this stuff has confirmed what I'm thinking. So I have extra money in my wallet from these ideas that we're coming up with here before the summer. So there you go. And then we're going to go over to developing markets. Again, these are emerging markets. And this is a one-stop shop for the emerging market. And again, we are of the opinion that these guys will also benefit as things go on. Again, the buy signal comes in the same time as value and all the rest of them, right? And as you can see, it's been going up nicely, had a pullback, okay, got everybody scared out, got the RSI under 50, and it got under the averages. So again, it looked bad, but again, it seemed to be able to repair itself. And so that's why we're constructive on it. Again, that's the whole story, is try to get into things when they're on the right side of the moving average and when your RSI is above 50. Okay, we'll get into discipline in a minute, but that's a little bit of an idea. All right, so next thing would be Pacific Rim. And not Pacific Rim, but just Pacific, which would be more for Japan, Korea, and Australia, that kind of thing. Okay, so here on this one, it has been weakening a little bit lately, but we're watching out to see if it's going to get back on the bicycle. And it looks like it might. So again, same type of buy signal as the other stuff we're talking about. And then a little bit dodgy here. Certainly if you got to 84, it would be better. But the RSI is probably still hanging in there. Yeah, it's right around the 50 area, right? Right now it's at 47. So if this thing can get through 50, and if VPL can give me a print of 84 or better, I would think that it's back on the bicycle. So keeping on that. This thing had a big run. That's why it's tired. Japan's Nikkei, it finally went back to the 1990 price, which took, 30 years to get there. So, it's had a big run. And Korea's done a great job. Their trade exports are tremendous. So when you hear our trade deficit is ridiculous, this is where it's going, overseas. So that's why we're very constructive on Europe. That's why we're constructive on Asia and developing market and emerging markets, because these guys should be benefiting from the fact that we're spending a ton of money, and the stuff that says made here, made here, made here, that's where the money's going. Okay. All right. So there you go with that'll give you the Pacific area. Next one, we went over those two, and then we're kind of taking a look at China, because they've had a drop because they've gone to war with their companies to try to get them under control a little bit. I mean, Baba, Baidu, JD.com, Tencent. I mean, these guys have gone nuts. Their values just went crazy, and they just are trying to do what? They're trying to get these things a little bit more under control with regulations, so it's not the wild, wild west. Now, do they want their companies to flourish? I believe they do. Are some smart investors looking at these? Well, Charlie Munger and his newspaper that he's involved in, they just started to buy some Baba, which I'll show you in a minute. And to give you an idea, the PE ratio and the price to book ratio have dropped since September 30th on the Chinese sector. On some cases as much as 33%. So they have come back in. They had very high valuations, plus the government came down on them. So they came back in, and they may represent some value here, particularly for longer term holders. So this is large cap China, and large cap China is looking at an RSI that's under 50. So really, if you're a momentum player, you wouldn't touch this thing until it started going at 48. And then if it got to 48, you'd probably get above 50 on the RSI, and it'd be a safer time to take a look at it. So that's basically what we would be thinking, rather than trying to pick a low, because maybe they're going to tank this thing even further. It could go down into the low 40s, right? And so basically, if it got to above 48, the RSI would be turning up, and you'd be above the moving averages, and it would be a more constructive place to be. Turning towards Baba. Baba was up strongly earlier today. I think it's backed off a little bit here. And again, it's still going through a back and forth activity, as you can see. So again, same thing here. It's very close to the 50 number. It's trading right now at 47. So again, wouldn't it be better to wait for 240 or better and jump on a train that might be going north where your RSI is back above 50 and you've been able to take out that point, that would make more sense. And looking at KWeb, which is a group of internet companies. But the reason you sniff around at it down here is they're out there trying to make money. They are coming up with stuff all the time. And they used to be a heck of a lot higher. So that's why you're kind of interested in it on this discounted price. But if you're a momentum guy, it doesn't have the momentum you're looking for to get in just yet. So here your RSI is under 50. That's not a good thing. And you're underneath the blue lines, not a good thing. But how about if it started to break 80? That'd be pretty interesting. So this is the kind of thing you put on your radar, but maybe you don't pull the trigger on here just yet. Because if you're looking for a momentum to be positive, it's just not happening right this second. Again, the last area I'm going to go over here is going to be in the gold and silver, because if inflation is coming back and interest rates are going to be held low, in our view, that's the nirvana for the metals. It was the nirvana in the early 80s when Jimmy Carter was in there, and the late 70s where the inflation was going nuts and the interest rates were low. We're seeing a similar scenario here with the relationship with 4-week treasury bills at 0 currently, and inflation picking up, and people like Warren Buffett at his last meeting here talking about how prices are moving up in his business, and how you're looking at situations where we have a economy pent-up demand causing some red-hot activity. Whether that'll persist or not, nobody knows. But here, let's take a look at some of these metals and see what we think. Here's a group of gold stocks on GDX. And you can see here, it came down, tested the averages, it's come back up, and your RSI, which was under 50, is now going through 50. So this is very interesting right now. And this is something to focus on in our view. Next one would be the silver. And there's many different ones out there. I'm just, obviously I can't go through every one of them, so I'm just picking some of the ones that we're following. And then there you go. You're looking at silver again. You can see that's breaking through the 50 number, and that's trying to take off as well. And so those are two right there, the silver and the gold, that are interesting for people who want to have some kind of a hard asset. It looks to be like it's trying to make a little bit of a turn, so you keep an eye on that as well. Okay, I've got about a minute to go here before we're going to sign off. And I did want to go over again the discipline aspect, because again, that also helps you with your time management. If you don't have any parameters, if you don't have any, shall we say, guidelines on what you're doing, then you end up staring at the screen all the time, and it takes all your day to do a couple of things. And that really is where the time management comes up. If you have the discipline of using the moving averages, if you have the discipline of using the RSI and using the dynamic between the two, it can give you a good discipline, because you want it above 50 on their RSI and you want it on the right side of the moving averages. Whether if you're bullish, if you're bearish, you'd like to see that RSI under 50, and you'd like to see the price on the wrong side or the underside of the moving averages. That gives you discipline. That gives you time management, because you'll have time to do a little research, watching your Bloomberg, your CNBC, your Fast Money halftime report, whatever you're looking at. And you'll have time to watch a little TV, because you've got your parameters set up, you've got your discipline set up, and now you're just sitting back and waiting. So that's our input on trading psychology, sectors, and asset allocation percentages. And then as far as time management and discipline, we think that comes from having a plan. And then once you have a plan, you execute your plan, and then you spend your rest of your time trying to do homework and research, finding out what all the talking heads in the world are saying, and come to your own conclusions, because at the end of the day, it's your money. So again, that's our view. That's our observation. This is optionprofessor.com. You go there. If you'd like to get our weekly newsletter, you can go and get it. And optionprofessor.com/subscribe is the way you do that. It has been great to talk to you here today. We look forward to talking to you in the future. And again, don't hesitate to even shoot us an email at optionprofessor@gmail.com. If you have any questions, we invite that as well. That's it for today. Thanks a lot for listening. And I hope I helped you with some of the information that we shared. Have a good day, everybody.